Friday the 17th of January 2025 price action review. I will be going over the NQ today and specifically look into the large pre-market session expansion that we saw today, high resistance liquidity driven conditions during the opening range, and in closing, pre-market setups. Starting off with a daily chart, a weekly chart, excuse me. The time frame I derive my weekly bias from. Every Sunday I am pretty much deciding, do I anticipate the market to expand higher, or specifically do I anticipate the next weekly range to expand higher or lower. That's how I derive my bias on a weekly basis, simple as that. So the market traded down into this bullish order block on the weekly chart and did it on Monday, and then showed the rejection of it, expanding higher throughout the week into internal range liquidity to external range liquidity, simple as that. From bullish order block, now reaching towards the highs above, and eventually perhaps, or I anticipate to see the all-time high being ran again. Key levels here are this previous week high for next week, so a small forecast in it for next week, this previous week high, this previous week high, and then the midpoint of this week, and eventually the all-time high are my biased objectives for the upcoming weeks. So one little thing, why did I pick this order block? Or why did I define this down close candle as the bullish order block? Because, and why not then this down close candle? Because this down close candle is pretty much encapsulated inside of this order block, so I just traded down into this one and then showed a rejection higher. Then we saw price trade down into this down close candle, eventually violating the mean threshold. That is when I immediately reverted back to this specific order block and looked for price to trade down into that, also because it is converging with this inversion fair value gap. So we had several confluences there, and I was observing, can we trade below mean threshold with a closing basis, or do we immediately show a rejection the moment we trade down into it in the beginning of the week? That's what we did directly on Monday. So once that happened, I was already looking for reasons to see the weekly range expansion higher in line with the higher time frame order flow, monthly, weekly, daily. I don't want to fight that and just rather side with that instead of trying to pick a top. Alright, daily chart. You can see how the market respected this volume balance, which was nested inside of the weekly bullish order block. Note how the wicks are beautifully respecting that volume balance here. It's very algorithmic. That's at least every time I see signatures like this, I know that an algorithm is responsible for the price delivery and not just buying and setting pressure. Because if you really believe in buying and setting pressure, how can price be so, how can the precision elements be so there at specific PD arrays? Like, always. Unless of course known from payroll and first day, then it can move a little bit beyond the boundaries, but in general it will really respect it nicely. Or it has mohawks also here, as here, when price wicks below the volume bands, only to reach down into a inversion fair value gap right here. So the market then formed a swing low on the daily chart, daily swing low that in itself can provide you a daily bias, not for the very next day per se, because that was, you can already anticipate the swing low to form here, because we traded down to a higher time frame discount rate and showed a at least initial rejection of it. Then you watch the next candle, can we form a swing low? That's what happened there. Then on the fourth day, when we have the swing low in place, we can then anticipate the fourth and or fifth candle to reach for the high of the first candle that makes up the swing low, which is this specific high. Notice that the fourth candle has a large range expansion higher to take out that high of the first candle of the swing low. And then the fifth day has a rejection of this order block, trading back into the inversion fair value gap. And then on Friday, we saw an expansion higher, confirmation of the expansion. That was set in place here. Notice that we had a change in the state delivery here. Once price traded above the opening price of this down close candle, a change in the state delivery is pretty much in place. Why did I refer to this candle and not one of these? This one is the most beefiest down close candle. So you could wait all the way for a shift market structure here. But I think this is sufficient, especially coupled with the fact, and mainly derived from the fact that we close strongly above this CB, turning it into an inversion for value gap, as you perhaps can say. That was like the main catalyst that I switched to not looking for a continuation lower and instead look for higher prices, and of course the bullish order block on a weekly, daily volume bands, etc. But note how price traded down into the inversion fair value gap on Friday, and then saw a range expansion higher, leaving this small little portion open, which is a fair value gap, and more specifically a balanced price range, leaving that open, acting as a breakaway gap. That's rare, like signatures that when you are anticipating to see higher prices, or at least looking for it, seeing a breakaway gap like this really supports that idea of higher prices, as it's basically acting as a fuel on the fire, you could say. Accelerating price higher is basically what I'm looking for the upcoming days, because of this breakaway gap. So, well, I'm just gonna do a forecast inside of this video. What would invalidate my bullish stance, at least on the very near term? And then I have to reevaluate either anticipating a confirmation of the consolidation that then will be established, or switching to bearish, or yeah, I would say at least reevaluating my bullish stance. That is, if we would violate the what I would like to see is for the next candle the next candles to respect consequent encroachment of this premium wick, their wick here, specifically an inverse discount wick, yeah, inverse premium wick. I would like to see a price respect that. That would be ideal. I don't want to see price come all the way back down into this inversion for value gap and trading down into that small little balanced price range that we have here. That would really not be in support of my idea of higher prices. So basically, I just want to see price respect the midpoint of this inverse premium wick. If it does that, then I just look for a range expansion higher towards these relative equal highs and eventually the all-time high. So I am bullish on the Nasdaq, at least as long as that is in place. So 4-hour chart, weekly internal range liquidity to external range liquidity is a 4-hour market maker buy model. Market maker model is it, and because we are in bullish order flow, at least anticipating the weekly range to expand higher from a discount array to a premium array, it will be a 4-hour market maker buy model. So that is then the correct interpretation of this piece of text. So if a market maker buy model here, the 4-hour chart, smart money reversal here, then low risk buy near the smart money reversal. Notice SMT taking place there. Then a range expansion higher, very clear, distinct. This was with CPI. Then the market comes back down into this balanced price range. Why is it a balanced price range? Because we efficiently offered both sell side delivery and buy side delivery. And then come back down into it. It is balanced price range. What kind of reaction do we anticipate to see there in bullish order flow, anticipating the market to trade higher? We want to see price stay above, ideally above the midpoint of the balanced price range. And we want to see a quick rejection and large consecutive up-close candles higher, and that is exactly what we saw here. Simple, very simple internal range liquidity to external range liquidity play from a, well, you don't even have to see, you have to have seen the busy here of the balanced price range here. If you only would look at the busy and then this old high, you would just anticipate the market to trade down into this busy and then trade higher towards this old high. That is, you don't even need to know the balanced price range to derive at that bullish bias for intraday price action. But I did have that information, so I was specifically looking for the balanced price range to support price going higher, and I expected then the lower half of this busy to remain unfilled for the reason that I anticipate to see, I was at least looking to see the balanced price range provide support. What if it would have closed below the balanced price range? That would at least be a whole lot less bullish than what we see here. That means that it would be violating a discount array where I would usually anticipate the market to respect, and that would be a whole lot less bullish. It could still have gone higher, but this is more ideal for a quick delivery higher, and that's what it did, a very sudden delivery higher, taking out the old high, and once it did this, the drawn liquidity was basically met, and I was basically done for the day, because it was Friday, so in general, the PM session on Friday, I don't tend to assume major risk in terms of taking several trades. Often I don't even trade and just tape read the PM session on Friday just for sake of, I don't want to, there's no need to go into the weekend with losses when it's not necessary, as it tends to be more consolidating, and that was exactly what it was today too. But we have low resistance liquidity run signatures here above, clear drawn liquidity. I would be looking for a second stage of reaccumulation around here, and then a quick sudden delivery higher to take out these red vertical highs, and eventually the all-time high for the same reasons as stated on the higher time frames. So that is something I will be looking for next week. All right, this was then the 4-hour chart. We had actually, I didn't even mention it, but we had SMT here with ES on the base of a fair value gap. So fair value gap SMT is what you could call it, which basically means that in this case NQ traded down into a busy, or make it simpler, NQ traded down into a fair value gap, whereas ES did at the same time not traded down into its respective fair value gap. So that is left unfilled, and that is SMT, fair value gap SMT. So basically same idea as you look with lows. You look for a low and then a lower low in one market, and then a low and a higher low in the other market. That is a cracking correlation. You can look for the same thing with fair value gaps. So in this case, fair value gap gets traded down into on NQ, whereas ES does not trade down into its respective fair value gap. That is a fair value gap SMT. What does it tell you? That it is underlyingly strong in ES. So the stronger market of the two is, in theory, the ES. This is then also most often what will take place. And you can also look at the market structure. Which one is trading higher in terms of the market maker models? Which one is higher inside of the market maker model? Well, it's obviously ES. And Q has to cover a lot more ground to take out its original consolidation high, defined by this all-time high, whereas ES has a less range to cover to take out its respective original consolidation high. So that's like a very simple way to measure relative strength. Well, the delivery intraday, that can differ because NQ tends to outperform the ES, but on a 4-hour perspective, which is where the SMT took place, that is what is the case. ES is relatively stronger than NQ. Alright, 1 hour chart. You can see here a smaller 1 hour market maker buy model fractal. Those relative equal highs that I outlined on the 4 hour make up the original consolidation high of this 1 hour market maker buy model. So I pretty much only zoomed out to outline this market maker buy model. So I will now go over into a more zoomed in version of this chart. Notice here the SMT taking place. SMT fair value gap that we outlined on the 4 hour chart in more detail here on the 1 hour. Then specifically diving into today's price action. Note how the market traded above this new wick opening gap and then turned it back down into it, now providing support. So it's really a dynamic PD array in a sense. Any PD array is dynamic in that they can provide a premium array can provide initial resistance, but once traded above, it can act as a support level in real terms, that is. Now, that is the same thing for a new wick opening gap, except that it is a neutral level from the start, you could say. Is that correct? No, that is not even correct, because a new wick opening gap is either gapping higher or lower, which is that either is a premium gap opening or a discount gap opening. So it already has initially a premium or discount array label. So it is, yeah, it's actually not true what I just said there, because if the market gaps up higher, then it is a premium gap opening. That means that when price trades back down into it, it initially acts as a discount array. But that's more what you label it yourself to it. In essence, it is a neutral level, just a dynamic fair value level, which means that it offers fair value to smart money to buy or sell at. But in this case, we see the market trade up above the new wick opening gap and then come back down into it, acting now as support. Why? Because we had the narrative in mind that we are anticipating to see higher price from the higher time frame, and specifically looking into the 1 hour, the market traded down into a discount defined from this dealing range low, dealing range high, 50% is around here, trade down into a discount, into this fair value gap, expands higher, then down into new wick opening gap, expands higher, and this was the most key level of the day. Because notice that once price traded down into this discount fair value gap on the 1 hour chart, it saw a very rapid expansion higher to this new wick opening gap. And I will go into the event horizon on the last slide, I think, or one of the later slides at least, not the last one. A large expansion higher into this new wick opening gap, and then the very next candle expands higher, takes out this previous day high, and reaching up into that premium fair value gap that I outlined here on the 1 hour chart. And that was basically the end of the weekly range. It would then form this will be the high of the high of the week, and then closing near the high of the week, and it met its buy side liquidity draw. So everything that happened after it took out this high was for the larger picture pretty irrelevant. But on a lower time frame, we can of course see more refinement even here. But you could already see here it just went to consolidation into the close, as it already met its buy side liquidity draw. So that's why it's so important to refer to the higher time frame and just have a top down and also a bottom up analysis. Bottom top, I think that's the right word. To get a holistic view of the marketplace. But let's see what the 50-minute chart has to offer. So I'm basically analyzing on the fly. I have, of course, the few node points in the beginning, but then I'm just going off of what I see and go into things that interest me. I have, of course, the main points outlined, but outside of that, I just have to analyze it myself too. Yeah. And it's pretty quite an exercise talking for so long. I have to probably make these videos a bit shorter, but okay. Let's see. Yeah, we saw here that price found support at the new week opening gap. That was initially um, the thing that we saw throughout the London session. I woke up not later, but I did not observe the London session myself. So when I was opening up my charts, I saw around the just before pre-market around 6:30, I think. I was observing the price action that I saw in London and analyzing it. We saw this range expansion higher, clearly seeing price find support at the new week opening gap, having some measure of manipulation below the midnight open in London. So I would already, at this moment, I anticipated this to be the low of today. And just look for range expansion higher. Then I was observing this 50-minute fair value gap when price traded down into it. I was looking for a potential buy setup going into the 8:30 news driver, but what I saw did not surprise me. But no, it did not surprise me. But I was looking for another discount array retracement in between. Considering that we had no news today, I thought it would perhaps be possible for the market to have some another retracement here. It is, however, not given to me. It was just one-sided expansion higher after it traded down into this discount fair value gap, another fair value gap SMT with ES. Notice I am also predominantly looking for divergences with the S because IN tends to be sometimes like a wild beast, meaning that it does not always get in sync with AS or NQ. I think I outlined it in the previous video, but that's like the main reason why I'm just looking for ES. I just trust it more. I think it's much more trustworthy, and I think IST mentioned it. Yeah, IST mentioned it too, that it is more. The moves tend to be more trustworthy itself. I have some storage still. Yeah, but let's go back to the topic. Yeah, that large expansion higher, very large expansion higher relative to the range that we saw prior to it during the pre-market session. And if we have a large pre-market expansion, which reaches for its higher time frame drawn liquidity, then anticipate to see high resistance liquidity room conditions in the AM session, specifically the opening range. Now, why specifically the opening range? Opening range is defined by 9:30 to 10 a.m. I could extend it to the high resistance liquidity runs conditions to see up to 10:30, because usually if the opening range between 9:30 and 10 a.m. is consolidating, then it quite often not always, quite often extends to like 10:30. But I did not include the whole AM session because usually around 10:50 to 11:10 you have that macro, and that's usually when some kind of impulse price swing starts. Sometimes just prior to it, and then it continues in during that macro. But yeah, when you see a large expansion in the pre-market session, a lot of the times you do see a high resistance liquidity conditions in the opening range, and often also consolidating where just range bound, and that's what we see here. So we had that initial drop down at 9:30 and back into the opening range gap, and then once it traded down into the opening range gap by a little bit, it rejected and went into back and forth price action. We had an SMT there, and then the market expanded higher. Notice the influence notice the influence of the new week opening gaps on today's price action. Note how the market reaches here one-sidedly throughout the pre-market session for its drawn liquidity in the form of that 1 hour premium fair value gap. Then once it reached that level, also taking a buy set here, it rejected of it, saw some retracement lower. But note then how the bodies are all respecting this new week opening gap. In general, new week opening gaps are just a very interesting. It's very an interesting topic to do case studies about, because it's just very note first how price trade up into the new week opening gap here, and then the next kind of opens up, trades lower, nearly hits the low of it, and expands higher. Then once the draw has been met, you see that they don't provide support in this one here because it is in high premium. So the market wants to trace down into a discount, which it does here. I think just hitting into equilibrium is what it does here. Defined by this dealing range low because it took out sells liquidity, this dealing range high because it took out buys liquidity. Just hit equilibrium here. But notice how the wicks trade down into this fair value gap while all the bodies remain inside of that new wick opening gap. You can't tell me that is random. Very precise, and I was watching intraday price action, just saw the difficulty that price had to trade below that new wick opening gap. It's like, well, like I outlined it here, mohawks reaching down into the fair value gap while the bodies remain inside of the boundaries set by a previous week and new wick opening gap. That must be random. Just it really is like boundaries set by these new wick opening gaps, just preventing price from trading below it with on a closing basis. Only wicks trading down into the discount array, which resides just below the new wick opening gap, and into a discount. While the bodies all remain inside of this, and that was like the signature that I trusted that the market would see another confirmation higher towards this rejection block at least. Intraday it was very clear to see that NQ had a much tougher time trading higher than ES. So considering that he had this long wick, I was not demanding for it to take out its high and just trade up into this rejection block. It would eventually trade up into the midpoint of it, and then just trade lower, diverges at the highs with ES, which did took out its respective AM high, and then eventually closing near the high of the day. But note here too how price finds support at levels of the new wick opening gap, expanding higher, initially rejecting, finding resistance at the upper new wick opening gap, closing around it, and then next candle expanding higher. Intraday you would probably see lower time frame candles finding support at this new wick opening gap. That's something to look into. And then expanding higher, trading back down into the new wick opening gap, and then another expansion higher to trade up into this rejection block, and then, like I said, closing near it. One more thing, notice how the market used this a news driver as a accelerator to send price higher at a much faster rate than it perhaps would have done it. It was only medium impact, so I'm not leaning too much heavily on it. But yeah, what you often see is if a significant level of sales liquidity has already been taken prior to the news, then the news driver will most often be used as a accelerator to send price quicker to a level of buy liquidity it was already destined to go to, one could say. So it just yeah, it's like fuel on a fire, reaching for a level at a much faster rate than it would have otherwise done. Yeah, 2-session up close day. That's basically the profile of the day. Classic buy day. You have several words of that, although they kind of differ. But let's dive into the 5-minute chart because I have some more to talk about. Okay, 5-minute chart. There's not much more to talk about here in the 5 minutes. Basically the same thing. You can see more refinement here around the new wick opening gap. If someone watches this, I would advise them to stop the video here and just observe how price behaves around these new wick opening gap levels, and specifically look at both the wicks and the bodies separately, because it's really interesting to see the difference between the two, and also how they relate with other discount and premium arrays that resides in and around them. Outside of that, we can have a very quick look at these details that we see here. And yeah, one of the interesting things here is that the divergence takes place here between ES and NQ, where NQ makes a lower low, whereas ES makes a higher low. So notice how the bodies remain in the upper quadrant really of this new wick opening gap, and only a long wick, 2 long wicks reaching down into this fair value gap, and one of them taking out the sell side here, which caused SMT. But notice then how the bodies are just staying in the upper half, and things like this, are really telling for a expectation of seeing price to trade higher. Forming a swing low here, while the bodies stay respecting this new wick opening gap. And then the next candle, same thing. It's just fractal, and it's a very simple, basic idea, which can actually come from, it's basic analysis. With swing low, we can anticipate the fourth candle to take out the high of the first candle that makes up the swing high, and that would in this case be a change in the steady delivery. The moment it trades one tick above this opening price of this down close candle, that makes the change in steady delivery a reality, going from sell side delivery over into buy side delivery, and then we can look for a continuation higher. Notice how it has some back and forth movement inside of this specific new opening gap, and eventually expanding higher. And then overall, this price swing higher is much more high resistance in nature. And it was for the very simple reason that we already had a very large expansion throughout the pre-market session on the day with only medium and big news, and it being Friday, and we already met its higher time frame buy liquidity draw, and that was like the main catalyst for this more range bound back and forth type of price action. Although it does move higher, it does not really do it in a very clean fashion, and why I really focus on like that's just really the pursuit that I have, being able to trade and execute well in low resistance liquidity room conditions, and just stay out of high resistance liquidity room conditions, and being able to anticipate and differentiate the two of them. I think that's a real skill, and I think I already outlined it in another video, but yeah, that's just such a powerful force, really, because that means that you focus, that you execute when it's one-sided in your favor. The probabilities are in your side, they're just stacked, and then you will see that you get that higher win rate, and couple that with then a pyramiding, and things can really go off from there, because and it's also just much better for the psyche, not forcing yourself in high resistance liquidity room conditions, and just solely focus on those low resistance liquidity room conditions, and then executing there. It's like really being picky, and then when you get the opportunity in those conditions, really double down on them, then pyramid and stuff like that. Alright, I want to go into this 50-minute structure, specifically that makes up the pre-market session. So you can see the market trade down at this 50-minute fair value gap, and then had the SMT with the fair value gaps relative to AS. But I want to specifically look into the new company gap, this one, up to this one, and the midpoint is the event horizon. So once something crosses the event horizon, it has no choice but to expand higher towards the new company gap that resides above it. That is, of course, in alignment with the order flow, and having a close above it is what I'm at least looking for. I still didn't really give a lot of insight about this specific PD array, but I've noticed in my own observations that seeing a close above it is really what I want to see. I don't think, at least to me, wicks are not sufficient. But when you have a close like this above it, that just really indicates to me, yes, it wants to expand higher towards the new wick opening gap above it. It's going to act as a black hole to really suck price into it, and similar to them being here, but I already went over that in another video. So it was again the same idea, internal range to external range liquidity. This is a nested PD array, so meaning we have a 1 hour fair value gap, of course, supporting this idea too. This one is inside of that 1 hour value gap, and once it crosses the event horizon, really not expecting it just to go above these highs, but because it crosses the event horizon, then I looked for this new wick opening gap. So like the main point of the event horizon here is that it provides you a range of opportunity where you can expect the market to reach for. So if you would not have known this PD array, you would perhaps have only looked for this high as to be a final terminus. Perhaps, of course, you have these very clean right of equal highs, but this is another confluence where you would expect the market to continue to go higher towards this new wick opening gap. So that's a very powerful tool in my opinion. All right, and closing the 1 minute chart here, we can see it's not the last slide, but the structure that on the 1 minute chart that was in place in the pre-market session. Note how the market has this CB here, price traded above the CB. Now it becomes the inversion for a value gap. We anticipate to see the market find support at that specific level, and then specifically a change in state delivery right here. Only price has to go only 1 tick above the opening price, so a wick is fine. It does not have to close above the candle that makes up the change in state delivery. No. This is what makes up the order block. The change in state delivery is what makes a order block. It's not just the last down close candle. No, it's not. It's this very specific candle here. Notice how the sensitivity here around this level here to the tick. Market expanding higher. Another thing, why does it trade below that change in state delivery opening price to reach down into this inversion for value gap? Then we saw not consolidation, but smaller ranges, which looks like a consolidation on when we have all these large consecutive upclose candles. But eventually the market would expand higher, and notice how one-sided it was. It was just almost all upclose candles, and if you would not get on board here, there was really no opportunity. At least there was no opportunity for me to get in alignment with it. Yet of course this retracement to this value gap and then expansion higher, but it's so high in a premium. I don't engage in those type of moves. But it was really just interesting to see that one side delivery. I was looking for perhaps a 5-minute retracement here inside of this range. Would then potentially set up a 1 minute setup, which I could get in alignment with. But I didn't get the opportunity, so that's fine. But eventually price reached for the new wick opening gap, and using that news driver at 8:30 as an accelerator. Notice how small ranges take place prior to the news, then at the news freeze, large consecutive upclose candles reaching up into that new wick opening gap. Very interesting to see how it used the news like that. Really just sent price quicker towards that new wick opening gap than it perhaps would have otherwise had done.